Okay, let's get started, shall we? I recently ran into a colleague who has two homes, a primary home and an investment rental property in California. And due to prolonged business legal battles, both properties I know have been in and out of the delinquent mortgage foreclosure cycle for on and off for several years, like 5, 6, 7 years. This is the kind of person who is sort of always at the boundaries of the legal obligations. It's the reason why we have normally 5-6% of mortgages are somewhere in the delinquent foreclosure pipeline. There are life and financial events that make foreclosures necessary. It's why we have foreclosure law. And when I asked him how his year went this year, we hadn't seen each other in over a year. He mentioned that both properties are now current. They've been refinanced. They're under 3% and locked in for 30 years. He's basically done with that financial struggle part of his life. And that's when it struck me. Like if this guy is current on his mortgages, and in fact, he's got such a good deal locked in that he's likely shifted his energies elsewhere, and he'll likely never get behind on these mortgages again because he's got such a good deal. The payments are so low. If this guy is in good shape, think about how many Americans that also applies to. And so here's what this means to me. We started last year, January 2020, with the record fewest mortgages delinquent that we've had, at least in decades, under 4%. And the interesting thing is we are on our way to finishing 2021 at a new record low. So despite the pandemic, despite like the mortgage forbearance loans, all the doom and gloom and the potential things that could have gone wrong this year for American homeowners, things are so good for the American homeowners that a new normal level is being established. People have such a good deal on their mortgage being so low, locked in for 30 years with strong equity, that essentially nobody needs to go into the foreclosure process. So this new normal is what we're talking about today. There are some fundamental assumptions that have shifted for the American housing market, and it'll take 4, 5, 6, 10 years for the market to shift again. So let's look at the new normal. And what we're also going to do is look at the parts of the market that will return to the old normal, the things that will return to the old normal after the pandemic recedes and we move into normal cycles. We're going to start by looking at the market right now, looking at the data and which parts of those are new and which parts will return to old. And then we'll finish the call today looking at some local markets, a handful of local markets, and we can dive in and see like how the market's differing in different parts of the country. As we talk today, use the chat for your questions. Look in the chat for links. So we have a couple of people from Jeff and Lael from the Altos team who will be able to try to answer questions on the fly and also post links in there. So if I mention someplace that you can click through and go to, it'll be in the chat window. So use that. and we will, so let's get started. First thing to do before we dive into the data is I always like to mention that at Altos, we have published this ebook that is how to use market data to build your real estate business. This is for those of us who need to understand what the data is saying and how to communicate it to buyers and sellers, to people who are maybe on the sidelines right now wondering, like, do I take action? Do I wait? Like the answer is in the data. And this book helps you as a professional help your clients. It talks about how to use the data, what the data means, has some good scripts and good opportunities for using the data in your daily work. So if you haven't already gotten that ebook, click through. The link is in the chat there. Go ahead and click through to that and download it and build that right into your business. Okay, so that's the ebook. Let's start today with supply, inventory. Inventory of single family homes in the US is about 330,000 homes as of last week. That is up 7% from the bottom, which happened in May. So the market finally turned, and we've now got 5 weeks in a row of rising inventory, slowly rising inventory. 7% up from the bottom, but still 53% lower than last year at this time. And if you look a few years back here, you can see that really we're, 2/3 lower. We are remarkably low. And so while inventory is starting to ease up, and for some folks, it can be real tempting to say, oh, inventory is climbing. This is going to be a problem. But the reality is that inventory is so low that any climbing inventory right now is a long way from getting us back to normal. And this is a hint to some of the new normal that we're going to be talking about here today. The immediate sales phenomenon. Immediate sales is a phenomenon that we've been measuring this year, as demand has been so high that, of 100,000 homes that get listed for sale in a given week, a quarter of those are going within hours or days. So we've been calling these immediate sales. So these are get listed. We're going to take offers for the next 2 days, and then we're going to go into contract. And so these properties are moving so fast, they're essentially bypassing the active market altogether. They're going directly into pending sale, pending contract. We are now at peak buying season. So the May and June are peak buying season. And we can see that we have had 3 weeks now of declining immediate sales. So what this tells us, and the number that we're looking for here is, as this top here, 23,000 this week, starts to get fewer and fewer each week, that's actually going to be a healthy sign for our market. That means it's not so nuts for buyers that they are discouraged and walking away. Like it's a return to normalcy. And so that's going to be an encouraging sign that we're going to keep our eye on. So, we have 330,000 homes on the market. We also had another 23,000 that went immediately. So those, and by the way, there's a whole nother 30 or 40,000 that are going in the first week. So that level of demand is super high and keeping our lid on inventory growth. But the key to know here, and especially when we're talking about clients, is, hey, I hear inventory is climbing. Isn't that going to mean, for example, maybe prices are going to start slowing down? But really what that means is it's going to be a little better for buyers. We have a little more selection, a little less competition. And that's really what we're looking forward to in the second half of the year. So those are positive signals for the market. But let's talk new normal. here's another way to look at inventory. You can see here 6 years of inventory cycles, the whole year. The green line on top here is from 2016. And what this shows us is that each year we've had, for really a decade, we've had fewer and fewer homes for sale. We've had fewer and fewer homes for sale because as rates have been super low, it's been a very good deal for when home buyers, move up buyers in particular, to keep the first home as a rental property and buy the second home. Now they have 2 homes, and as mortgage rates drop, it's become more and more affordable to do that. It's become a better deal for rental income. And so we've taken 8 million homes out of the for sale stock and moved it into the rental stock. The majority of that is actually individuals, not like big hedge funds, although the big hedge funds are doing it also. Institutional money is doing it also. It's really the individuals who are leading that charge. And what we've shifted into is this new normal of all the way down here at the bottom. This is our 2021 inventory line. We can see that we are starting to get a seasonal pattern. We're a couple months behind. Normally inventory bottoms in February, March, and starts coming up. We bottomed in May this year. And so we'll get a little bit, we don't have steep increases in inventory, but our peak of inventory will be about end of the third quarter here, and then it'll recede for the holidays again. So there are no signals anywhere in the data that put inventory back to an old normal level of even 700,000, or really the normal level might be 1 million single family homes on the market. But there are no signals that are going to get us back there. In this data, you can see the yellow line is 2018, and this little tan line is 2019. So between 2018 and 2019, inventory increased a little bit. And what happened there is mortgage rates went from 3.5% to 4.5% in that year, and demand definitely slowed. It was more expensive to buy the second house, so more people sold their first house. And so more came onto the market, more inventory came onto the market. The difference between the yellow line and the tan line, just a little bit. And so as rates rise, or assuming rates rise, you can imagine that we will shift up and have more inventory, but the shift will be a few percent more. Maybe it's 10% more, but there are no signals that get us back to this old place of 700, 800, 900, 1 million properties. So this inventory shortage is likely to be for the next 3, 4, 5 multiple years until we have a bigger structural change. Multiple years, for example, of significantly higher interest rates might change that. One of the other ways to look at this is how inventory changes per week. So in this chart, inventory changes each week. And what you'll see is that each year, we normally have the first and second quarters when inventory builds. Third and fourth quarter is when inventory recedes. Last year, we had only a few weeks of rising inventory before the demand kicked in, the pandemic demand kicked in, and the market shrank. This year, we've had a handful. The dark green is we've had a handful of weeks of climbing inventory. And the light green is the next few months to come. We'll have a few more weeks of climbing inventory, but pretty rapidly into the third quarter, inventory will start declining again. And what this shows us is that there's really no way for inventory to climb substantially in the second half of the year. That all happens in the first half of the year. So any real inventory shifts will be not until second quarter of next year, really a year from now, before we could even break out anywhere out of our tight inventory. And so this is why we're talking about it's a new normal, at least for the next several years, of being in this ultra tight inventory market. And of course, one of the reasons, so mortgage rates being low and allowing people to own multiple homes has kept inventory low, but also construction. We've underbuilt for a decade. And so you can see that, even though new construction is rising and getting back to normal historical levels, it'll still take 3, 4, 5 years of building and significantly higher building to build up any sort of inventory of new homes. So all of these things point to this new normal of ultra tight inventory. Okay, let's shift from supply into pricing. The home prices this week, the median home price in the US, single family homes, is $399,000. It is flat, ticked down from last week. Last week was $399,900. And what we see here is a return to a normal seasonal cycle. Home prices, demand in home prices peak each year, the end of June, and they tick back through the third and fourth quarter. Last year was the exception to the seasonal pattern. And you can see last year at this time, we were at 349 and home prices kept rising well into August and then didn't even recede much in November until right at the holidays. So the last year was unseasonably strong through the third and fourth quarter. What we can see now, and I look at this as a positive sign that home prices are returning to a normal seasonal pattern. And that means that if, for those folks who, there's still a lot of market bubble fears, like prices are up so high, are we in a housing bubble? And if we were to see prices skyrocket through the third and fourth quarter this year, that would be scary. That would mean demand's happening. There's things like fraud or all the kinds of fears, the buying fears, I got to get in now, those types of fears that happened during bubble cycles. But what it looks like we're getting is that we're going to return to a normal seasonal pattern. And therefore, we just had some real strong years, but not like scary bubble conditions. The bottom line on this chart, the gray-green line here, is the median price of the newly listed cohort. And that's each week the new listings come to market, and where are they priced? Because they are new, they're a leading indicator of the overall market. And each year, normally the new listings peak in May. So the new listings prices peak in May, and then the overall market peaks in June. The sales numbers peak in July, and you usually start hearing about that in August and September. But we can see in the data right now that this year, right on cue, the new listings that is now at 359,900 and peaked in May, right when it normally does. You can see in previous years, 2018, you can see it peaks 2019, it peaked in April and May. 2020 was the only year we had the few weeks of pandemic down, and then we had the late summer that was still climbing all the way through well into the third quarter. So what this tells us, this is super encouraging. This means that because we're having nice normal seasonal patterns, we had a big up year, but normal seasonal patterns means that we're not lurching into bubble territory from here. It also means, interestingly, because pricing hits that plateau, the median price will likely stay under 400,000 for the year and not tick over 400,000. And that might be something that we'd break, level that we break next year. So we probably hit our peak of pricing for 2021. Another way to look at what's been unusual for the year and whether we move into new normal, old normal, is year-over-year price gains. So right now we're at about 14.5%, 14.3% year-over-year price gains. A big year for home equity gains for homeowners. Um, uh, as prices have gone up, that now and rates are basically unchanged from last year at this time. Affordability is a little less, so buyers are starting to back off a little bit. So the old normal assumption would be 3 to 5 year or 3 to 5% a year would be a normal assumption about home prices. And what's going to happen this is we're going to compress again, so we'll finish the year at 10 or 12% price gains for the year, and then next year fall back into a normal 3 to 5% range, and we'll be back in that range for the foreseeable future until there are some significant changes in variables like the economy change or interest rate change, et cetera. So again, the old normal is really good to see that we're not like lurching into bubble territory. The price gains are backing off. We have year over year comparisons of when things were really depressed at the beginning of the pandemic. And so that is something to assume going forward. We're not assuming that next year is going to have another 14% year. We're going to recede back to the old normal range on price gains. Likewise, we track at Altos a percentage of homes with price increases. But this number is really an indicator of things like investor demand, investor activity, and when a market gets very speculative and bubbly, then that starts to go super high. And what happens is house is on the market, investor buys it, comes off the market, maybe there's a little fix, it comes back on the market at a higher price. And so we were tracking this, and earlier in the year, 8%, 9%, in some of the hotter investor markets, that you could see that in like 18, 19, 20% of percentage of homes on the market that were on recently lower. This is also a function of the iBuyers. So the Zillows and Open Doors will buy properties at lower, they'll do their thing, and they'll relist it at a higher price. So you can see that activity there. If this number were too high for too long, that is speculative, and those are the bubble signals. The price increases are backing off. That is a healthy activity for the market, and therefore it allows us to be not so fearful of some kind of bubble bursting. It's also, if your buyers are out there waiting with their cash saying like, oh, I'm just going to wait till the bubble bursts, then I'm going to swoop in and take and get my properties. The real question to ask for those folks is, how long are you going to wait for that? There are really no signs that that's coming, and there's a lot of signs of like healthy behavior in the market, despite despite the big up year in price. On the demand side, there is often a historical approach to measure demand in real estate by sales rates. How many houses sold? And if fewer houses sold, that must be because there's less demand. But in a supply constrained market, you can't measure that by the transaction volume. There's more demand than there are homes. So we use other signals to measure demand. One of those is the percentage of homes on the market taking a price reduction. Normally, the old normal would be about 35% of homes are overpriced when they get listed, and they take a cut before they move, before they get sold. And so about 35% do that. Sometimes that's strategic. That's like if I don't take one price cut, I underpriced. Sometimes it's accidental. It's like a wacky seller, whatever the reasons are, but it's about a third, 35%. In hot markets, maybe that's 25%. So a third think they're overpriced, but some of them got the offer they wanted and they never had to take their price cut. And then you can see in the last year, that percentage plummeted into the low teens. And so 35% of them think they're overpriced, but only 14% of them took price cuts. Before 2020, the 14% price cuts was really the domain of only like the craziest, hottest California markets, like Palo Alto. There's only 20 homes for sale for 70,000 people, and they all get bid up. So, but this year it was the whole country. And you can see obviously the pandemic demand kicked in hard, kept price reductions from happening. So all of last year, homes are raising their price, they're listing higher, but they get the price. They didn't have to take the price cut to move. That resets always after January, gets lower. And so now we're starting to see a little bit of seasonal pattern there. And so again, that cycle looks healthy for the market. But what's new, our new normal for the market is the demand, the millennials. So there are more millennials than any other population group, even than the boomers. And the millennials are now in their mid-30s. They're moving into peak earning and home buying years. And so we have another 5+ years of millennial demand, plus our inventory shortage. And this is the new normal. These are demographic trends that there's no stopping. And so for those who are wondering what might be the case for the next few years, is even in a slowing economy, there's still more millennials than there've ever been of any other demographic cohort. So the demand is still there in a new normal sense. I'm a Gen X. We're the smallest group. And when we hit our peak earning and home buying years, that's 2008. That's when there was fewer of us, all of a sudden demand could back off because there's less of us. Now the opposite is true, and it's true for the next bunch of years. So when we talk about new normal, it's really fascinating, right? Prices aren't skyrocketing, and a new normal in people thinking about prices rising 15% a year makes bubbly conditions, makes fraud conditions, makes create bad decisions. Those things are not, they don't have to be the case, but we do have a new normal of supply and a new normal of demand kicking in. And those are the things to make sure your clients are aware of when they're making their decisions. Let's do another couple on demand. We'll look at mortgages, and then we'll dive into some local data. The Altos tracks the demand versus supply in this one easy to view number. It's called the market action index. It works like a speedometer. And as inventory is tight and demand is high, this number climbs. If inventory starts to build, that number eases back off. There's a couple of things you can see. You'll look on every Altos report and you'll see the little speedometer. You can see where it is now and where it is last month. Because we are in June, June's the peak buying month, you'll notice that in almost all markets, the market action index is higher than last month, and it's higher than 2 months ago. That'll peak at the end of June typically and start easing back. You can see where I've highlighted 47, 39, 38. This is the previous seasonal peaks. And normally the market action index will trail off for the second half of the year. Last year was unseasonably strong in the third and fourth quarter, and just a rocket of demand first and second quarter of this year. We have now, though, it really looks like we can see the peak of demand versus supply. And so in the next few weeks, we'll start to see that be able to inch back down into a much more normal seasonal pattern. So demand has peaked for the summer. So the old normal is that we buy homes in March, April, May, June. And then in the third quarter, we start discounting to move them before school starts. And by the fall, if it's still on the market over the holidays, you take even more cuts to move it. Maybe you pull it off the market and relist it in January. And that old normal is returning. So the normal seasonal cycles are returning. Uh, and that's encouraging, right? That's encouraging for the bubble. It's encouraging for buyers. It's encouraging that things aren't getting out of control. So we have demand has peaked for the summer, and that means supply will build up for the next few weeks, and demand will start easing back down. So what we don't know is we know that because demand's high, supply's low, people are still gobbling up everything in sight. Market time is at record lows. 28 days, median days on market for the whole country right now. And I'll show you some of the local data where you can see the price points where it's essentially 0 days. And you're likely to know your local markets where you're feeling that exactly. This number, you'll see that we're right about the lowest point of the year each year, the 49 days, 56 days. And then in July, it'll pick back up a little bit, August, September. So then third quarter, that starts climbing as the stuff sits around at the end of the year. So we're going to return to our normal cycle. Last year was totally counter cycle where days fell in the third quarter. So this is a return to our old normal seasonal cycles. Still going to be a hot year. There's nothing slowing it down for the year. It is important to know that we started the year where I was assuming mortgage rates would be climbing this year. The economy is heating up and rates will be climbing. They did climb in January and February, but then they tick back down, and they are not climbing right now. And the 10-year bond is not climbing. In fact, it's been falling most recent weeks. So despite things like inflation fears, the fact of the matter is the markets are not yet driving mortgage rates higher. So that's bullish for demand. That means your buyers who couldn't get your homes earlier in the year, they couldn't outbid, they now have a little more opportunity later in the year. They had to still have those super affordable rates later in the year. So this took me by surprise, but yeah, I bought my first home 25 years ago, and I've been expecting rates to rise ever since, and I've been wrong for 25 years. So who knows where rates go from here? But as of right now, rates are still incredibly low. It's super favorable to the buyers, and so and that hasn't changed yet this year. Meanwhile, homeowners have added trillions in equity. So as home prices have climbed, and even as people are refinancing, the buyers are putting more cash in, like equity continues to increase. So the American homeowner is in the strongest position they've been in decades. They have cheaper rates. It's locked in. There's nobody on a short-term arm. They've got high and rising equity, record levels and rising equity. All of those things put the American homeowner in a very good position. And here's what that means for delinquencies. And this is remarkable coming off the year we've had. But the new normal is you can expect that mortgage delinquencies, foreclosures, short sales will be back at record lows by the end of the year. So even for folks who spent 14 months not paying their mortgage in the forbearance program, those folks are in such good shape that almost none of them are going into distressed sale foreclosure cycle. And so the number of mortgages in some stage of delinquency is now at 4.6%. 3.9 was where we started 2020, which was already record low. So this new normal, because everyone has such a good mortgage and so cheap, we're in a cycle where we're going to have very few things like short sales, distressed sales, and properties in the foreclosure pipeline. It's just such a shock from what we would have expected a year ago, that we're going to be at record lows again, but by the end of the year. And that has lots of implications. And lots of implications. There's still a big chunk of buyers, or people who have a doom and gloom view of the American economy and the American consumer, that really don't have visibility to this yet. It's a really different view than most of the world recognizes. So that is the last bit of the new normal to pay attention to. Okay, let's switch to looking at some data, some local data. I'm going to start with Denver today. I have a handful of local markets open. Denver is one of the hottest ones. It's still hot everywhere in the country, but Denver has tons of inbound immigration, a lot of California immigration. And Denver is on our market action index. The speedometer is just floored. It is as hot as it can be. We have seen inventory in Denver start to tick up a little bit in the last few weeks. And in fact, what you're going to see that the across the country with the local reports is inventory rising a little bit, and the market action index is up a little bit as we hit peak buying in June. And we'll see things though, like the percentage with price decreases start to tick up also. And that's because we're in this market where now there's people who put their house on a little bit early. They didn't go as fast as they wanted. Maybe they overpriced. And so now they have to start thinking about price cuts. So it's starting to tick up. And again, this is the return to the old normal, a good seasonal pattern where things start doing price reductions the second half of the year to move it before school starts. So that's the theme you'll see here. You can see in Denver, in the Altos reports, we do every market by price range segment. So the high end of the market may be behaving differently from the low end. The theme, of course, for this year is that demand's been across all price points in all markets. But what we can see here is in Denver, anything under $1 million or so is going essentially immediately. So that's this third and down, these three segments of the market, and over here on the days on market, over here on the side, 7 days. But the $2 million properties are taking a month to sell. So you can see where the demand is in there, and you can really see the impact, like the price points that are going to be most competitive. I know we have some friends in Ohio on the call today. I just grabbed Cleveland and just to see what's going on here. So, Cleveland's very different from Denver in that Cleveland doesn't have a ton of in-migration, but because rates have been cheap and the millennials are still growing, like we have the same dynamics in Cleveland. We could see that the market action index has ticked up since last month. It's June, so that should be expected. Obviously, still strong sellers market. I have the inventory chart here open for Cleveland. So Cleveland's off its bottom and up a little bit in inventory, but at 2,000 homes, it's still half of what it was last year at this time, and really 2/3 lower than 2 years ago. And so you can see Cleveland's old normal inventory cycle here, and you can see how Cleveland's inventory could climb a bit, but getting back to this old normal seems very unlikely to me. When we look at the price ranges in Cleveland, you can see two things that happen here. The demand in Cleveland is in the middle of the market, where the high end takes a little bit longer to sell, and the low end, these are 100-year-old urban properties that are under $100,000 and small lots. And so a little slower to move those as well. You can see exactly where the demand is in Cleveland on that. Let's look at Dallas. I've talked a lot on these calls about Austin, but let's look at Dallas today. So Dallas is strong sellers market. It's not as hot as Austin. It is ticking. It did tick up strongly in June. over May. So that's super visible. I have the price chart here for Dallas, and you can see the strong year-over-year price gains. If we switch this guy to inventory, we can see Dallas is barely eking up more inventory available. So likely though, you can see Dallas usually peaks pretty soon in inventory before the end of the year. So a little bit more inventory for Dallas. And in Dallas, anything under 800 grand is where the demand is here. 14 days, 7 days, really moving super fast. Dallas is one where the price increases, where a lot of investor activity, a lot of iBuyer activity. Earlier in the year, price increases 19% of the homes on the market were on the market lower and then bought or flipped, and they came back on higher. That's receded down to 10%. That's happening because it's more competitive for buyers, so it's harder to get flips done. It's also because as the prices adjust, the market is being sensitive to just random price increases. So this has come back down into a more healthy range. And so that makes me optimistic for the coming year for buyers and sellers. Let's do just a couple more and then we will wrap up. I have San Diego open. San Diego is among the hottest markets in California. San Diego also had a big price increase year. And you can see in San Diego, different from Dallas, only 4% of San Diego properties are in that like investor flip, the price increase mode. It's significantly fewer because it's significantly harder to do that kind of transaction in an expensive market like San Diego. In Orlando is interesting to me because Orlando actually typically lags the strength of the rest of like some of the hottest markets in the country. So Central Florida, you can see a lot of Orlando's price increases happened this year. And so what we had is they did their properties with price increase, the investor flips, et cetera, peaked at 12% and is now back to 8%. So this is backing off very well too. Same phenomenon as Dallas. And like Cleveland, you can see that where the demand is in Orlando. So it's right in the middle of the market. It is where the peak demand is in Orlando. The most expensive stuff, the $1 million property, is taking a little bit longer. Again, none of this is long, right? 40 days for $1 million property in Orlando is no big deal. So all of the signs, like the market's still super hot, but backing off just enough to get some breathing room in the market. No signs of doom and gloom anywhere. I have Bend, Oregon and Truckee. These are our Zoom towns that I've been referring to. These are where, with the remote work, people could move out of town and live in a place in the mountains or in the woods. Bend has a little bit of, I have the price decreases up here. And you can see normally the second half of the year, a lot of price decreases, like the market backs way off in Bend in the second half of the year. Last year, that didn't happen at all because all the Zoom town traffic moved in. So this year, though, it looks like we're going to get back to a more normal seasonal pattern. In Truckee is one of the few places I've noticed that is, last month, the market action index was higher. So Truckee's ticked down in demand this month. As inventory is starting to rise, coming off the record lows, and fewer people, in fact, I know people anecdotally who have now boomeranged, went from San Francisco to Truckee, now buying back in San Francisco after the year's up. It's a fascinating transition. So the Zoom towns showing a little bit of demand backing off, maybe the earliest leading indicators for the whole country. Okay, that is the data we have time for today. Usually by this time of the talk, people are asking me, can you look at my market? Like, can we look at a few more local markets? So the answer is yes, we can look at your local market. The best way to do that is to go to altosresearch.com and book a demo with us. We'll get on with one of our people and you can look at your local market. You can understand where your market's heading for the rest of the year and the best ways to describe that for your buyers and sellers to help them make the best decisions. So go to altosresearch.com right now, hit the little book a demo thing so that you can look at and we're happy to share your local data and how to work with your clients. That's all the time we have for today. I will stick around and we'll make sure that the questions are answered in the chat, and everyone will receive your copy of this webinar in your email this afternoon. Okay, thanks everyone.